Good evening, everyone. Welcome to our monthly financial literacy series of workshops. Minimize this. Welcome, everyone. Thank you for joining us. The Center for the Women of New York advocates for women's rights and full equality. Since 1987, CWNY has been empowering women to reach their full potential by offering services that provide the skills, information, and support they need to address economic, emotional, and legal challenges. We have two locations, both of them are in Queens. One is in Queensboro Hall, another one is in Bayside, Fort Totten. Here are some pictures of our annual walk. And the one on the bottom right is a self-esteem program that we run. It's our board, and together with Felicia's Promise board as well. Let's see. Tonight we have income tax basics for 2021 returns by Kathy Carroll. Thank you, Kathy, for being with us.
You're welcome. It's always my pleasure.
Thank you. Like most of you know, we have our webinars on different topics, domestic violence, trafficking, art therapy. We have to update this, like this from last year. Women empowerment. These are some of our services that we offer. We have a legal support team. We have two support groups. One is the weekly. One is for women in crisis, and the other one is for caregivers. Now we do have this workshop series. One is this one, financial literacy, and the other one is career series. We just had a resume writing workshop this month, and next month we have networking for a successful career. So everyone's welcome. Just join us. Those are very helpful for anyone who is changing jobs. I know, like, the pandemic has affected women disproportionately in the workforce, so we're trying to help out where we can. If you'd like to see any of these workshops that happened in the past, you can find them at cwny.org/past-events. If you have any questions during the presentation, feel free to put your questions in the chat. If you dialed in, you can email your questions to events@cwny.org. We also have with us Lana today, Lana Paluitz, who's an amazing volunteer. She's going to be monitoring the email. Again, Kathy, thank you so much for being with us, giving us valuable information about taxes that are ever changing.
That's for sure.
Looking forward to hearing what you have to say about the income tax for the returns for 2021. So welcome.
You're welcome. Okay, so welcome and thank you for joining the webinar. The tax season for the preparation of 2021 income tax returns is well underway. By mid-February, most taxpayers have received their W-2 forms, bank interest statements, and other documents that are needed to do taxes. In general, the tax law has remained the same as in 2020. The major differences for 2021 involve the pandemic-related items that would include the stimulus payments that were given out in 2020 and 2021, the taxability of unemployment insurance, and the advanced child tax credit. The first thing that we have to speak about doing any tax returns are our income documents, because that's the basic starting point for the tax return. The most common types of income and the documents that people receive to report it are W-2, which is for wages, a 1099 NEC, which is for self-employment and independent contractors, and 1099-G, which is unemployment compensation. W-2 forms are received in a typical employment situation where a person works for a company. The W-2 will show one's earnings for the year, as well as any deductions for a 401k, and then Social Security and Medicare tax that are withheld, and federal, state, and city tax withheld. The 1099 NEC replaced the older 1099 miscellaneous in 2020 as a document to report self-employment and independent contractor income. So unlike a W-2 form, where a tax return must be filed only if the income exceeds the standard deduction or if tax is withheld, so that someone can be entitled to their refund. If the income on a 1099-C exceeds $600, a tax return must be filed. In most instances, the recipient of a 1099 NEC will report the income on a Schedule C, profit or loss form for business, and will be able to deduct business expenses spent in earning the income. Because on the 1099 NEC, there's no tax withheld at all. So the federal income taxes, state and city, as well as Social Security and Medicare have to be paid by the individual. So even if someone's technically not running a business, if they receive a 1099 form, they have to report it on the profit or loss for business to Schedule C. Unemployment benefits, 1099-G. Now, over the last 2 years, many people have been unemployed due to the effects of the pandemic, unfortunately. And due to the pandemic, the federal and state governments extended the time frame in which one could collect unemployment benefits. Typically, in the past, unemployment benefits could only be collected for 26 weeks, but in 2020 and 2021, the time period was extended quite a few times. And the federal government also gave increased benefits for a period of time. In 2020, they were giving out $600 extra, and then they were giving out $300 extra. So a lot of people in 2020 got quite a bit of unemployment, but it also extended into 2021 that people were receiving benefits. So because of this, people collected significant unemployment benefits in both 2020 and 2021. In 2020, in the middle of the tax season, which made the tax season so difficult last year, the federal government announced that the first $10,000 of unemployment benefits would not be taxed. I mean, it's great for taxpayers and, very, very good for people, but very bad for tax preparers. And then New York State decided they were not going to go along with this. And the unemployment benefits that people received, even if they had a $10,000 exemption for the federal, all the unemployment benefits were taxable for New York State. That was in 2020. Now for this year, for 2021, this is why I have this in bold on the slide, because so far, all unemployment benefits received are fully taxable by both the federal government and by New York State. There is no current $10,000 exemption in effect. So if you received unemployment in 2021, it's fully taxable by all the taxing authorities. For many years, the New York State Department of Labor has not mailed out statements to recipients of unemployment benefits. The only way to obtain your 1099-G is to go on the New York State Department of Labor website and download and print the document so that your accountant or tax preparer can have the correct amount of benefits received, as well as any federal or state tax that was withheld, if any. So at the present time, many people aren't collecting unemployment. So you would have to go onto the website. You need to have your password and your username and all the information that you had previously when you were receiving the benefits. So that's kind of important to make sure that you have that information so that you can get back into the website and get this 1099-G. A major problem that may arise this year is that many people who received unemployment during the year have had little or no tax withheld. This has already caused some issues for some of the tax returns that I've worked on so far, as some taxpayers have received a lower refund than they expected or may even have to pay tax. This is particularly true in the case of New York State and New York City returns, as the Department of Labor does not provide withholding for New York City. So even if you had tax withheld from the unemployment, there will be no city tax taken out in any event. So since the state and the city, the taxes are filed on one form, if you had state tax taken out, maybe not enough, there would be no city tax taken out to cover that tax. So it's highly likely that recipients of unemployment may be paying the state for the city tax. Credits and deductions. The terms credit and deductions are both money savers for the taxpayer. Most taxpayers can benefit from either one or the other, and sometimes from both of them. A credit will directly reduce your tax on a dollar-for-dollar basis, such as the earned income credit and certain education credits. And some credits will even refund you the amount by which the credit exceeds your tax liability. That's not the case with all credits. Some of them, when you get to zero tax, that's it. You can't get a refund of the excess, but some credits you can. A deduction is an allowable item that will reduce your taxable income so that your tax liability will be lower. Deductions do not reduce tax liability on a dollar-for-dollar basis. The benefit is based on the individual's tax rate. Deductions are an allowable amount that will reduce one's income in arriving at taxable income. All taxpayers may choose to use the basic standard deduction to calculate their taxable income. Most taxpayers will have to use the standard deduction if their potential itemized deduction do not exceed the standard deduction threshold. The standard deduction is the basic amount allowed to reduce one's income. The amount of the standard deduction is based on one's filing status. The standard deduction has increased only slightly for 2021 as compared to 2020, but even a slight increase will lower one's taxes a bit. The following amounts of the standard deductions for 2021. For single, it's $12,550. That's an increase of $150 from $12,400 of 2020. Married filing joint is $25,100, also a slight increase. Head of household is $18,800, and married filing separate is the same as the single standard deduction of $12,550. Now, the state has, of course, has different amounts for standard deduction than the federal does. So the single standard deduction for New York State and New York City is $8,000. For married filing jointly, $16,050. For head of household, it's $11,200. Married filing separately, again, is the same as single, $8,000. Unlike the federal standard deductions, these amounts have not increased from 2020. So the state is just exactly the same as it was in 2020. So now the standard deduction for New York State and New York City is a lot lower than the federal amounts. So theoretically, if someone is at a lower tax level, if their income is low enough, that they may have to file a state tax and maybe not have to file, technically not have to file federal tax. But in any case, if you need to file a New York State tax return, it's always good to file a federal return as well. Itemized deductions are a list of specific items that, when grouped together, will lower your taxable income if they exceed the amount of your allowable standard deduction. For example, if a single person has itemized deductions in the amount of $13,000, it would be beneficial to use this amount rather than the allowable standard deduction of $12,550 for 2021. The process is not as straightforward as it appears, however, as we will see shortly. The types of itemized deductions that are available to taxpayers include medical expenses, which include insurance premiums, out-of-pocket expenses, co-pays, vision and dental expenses, travel to and from doctor's offices, such as cost of taxis, are also deductible. However, your medical expenses must exceed 7.5% of your income before you can use any of them at all. For example, if your income is $50,000, your medical expenses would have to exceed 7.5% of $50,000. This number that's here was from a previous webinar when the limit was 10%. So the limit has actually been lowered back to 7.5% from 10%. So there's a little bit more leeway, but you would still have to have quite a bit of medical expense before it would be able to be used as a deduction. Other types of itemized deductions include state and local taxes withheld from one's pay during the year, as well as any balance paid on a prior year's state tax return. So if you had to pay the state and city last year, theoretically that could be deductible on this year's return if you can exceed the standard deduction threshold. Now, real estate taxes are itemized deductions referred to as, with the state and local income tax withheld, they're referred to as SALT, state and local income taxes. The SALT deduction is currently limited to $10,000 per taxpayer. There has been much controversy about this limitation, particularly here in New York and several other highly taxed states, including New Jersey and Connecticut. In fact, the SALT limitations impact approximately only 10 states or less throughout the US. Although there has been some discussion regarding revision of the SALT limitations, actually that was going on within the last few weeks, it is still in effect for 2021 tax returns. They haven't done anything about that at all. So if someone has, if they're in a high real estate tax bracket area, like some houses in Nassau County pay maybe $20,000, $30,000 worth of real estate taxes, you're limited to only $10,000 of your real estate tax. So that really has an impact on how much total itemized deductions you're going to have if you're limited to $10,000 on that item. Mortgage interest is an itemized deduction that would include interest paid to banks and private lenders, including points and origination fees if you paid on a purchase. So if you just bought a house, when you go to have your taxes done, you should bring your closing statement to your accountant, because in addition to the statement that you're going to be getting from the bank, you may also have items on the closing statement that are deductible that won't be printed anywhere else. Charitable contributions can be deducted for both cash and non-cash items. If a cash contribution of more than $250 is made to a single recipient, such as a church or charitable organization, a receipt must be kept for your records. Non-cash contributions, such as clothing and household items, must have a receipt for contributions over $500. Many people believe that in the case of a non-cash contribution, the organization will let you know the amount. This is not the case. The organization will only provide a receipt saying that the item was donated, and it is up to the taxpayer to estimate the amount that the items were worth. Charitable contributions for non-item items. Charitable contributions have always been a favorite itemized deduction. It helps taxpayers save money, and it assists those that are in need of our help. In 2021, non-item items may deduct up to $300 for their charitable contributions. So even if you are not able to itemize, you can still use up to $300 of charitable contributions to reduce your taxable income. With the introduction of the Tax Cuts and Jobs Acts of 2017, that is the legislation that the current tax law is based on. The deduction for miscellaneous job expenses such as union dues, work clothes, work tools, work travel, job-related education, and other items that used to be extremely popular as deductions have been eliminated for nearly every type of occupation. So if you have small receipts for items that you purchased for your work, you really don't need to hang on to them because these items are no longer deductible and they haven't been deductible for a few years. With the exception of teachers. Teachers are allowed a $250 adjustment to income. It's not an itemized deduction. It's actually an adjustment to income on the front of the tax return for the purchase of school and classroom supplies. For 2020 and 2021, this includes the purchase of PPE, disinfectant, and other safety supplies for the classroom that are related to COVID-19. The bottom line on the itemized deductions is this. Due to the limitations placed on them, limit on medical expenses, SALT cap, and so forth, most taxpayers will not be able to itemize and will use the standard deduction. Itemized deductions can be used most frequently by taxpayers who own home and have significant mortgage interest to deduct. Unlike a deduction, a tax credit can save a taxpayer money on a dollar-for-dollar basis. In some cases, if your tax is reduced to zero by a credit, you may be able to receive the additional amount of the credit. This is known as a refundable credit. A quick overview shows at least 20 credits, non-refundable and refundable, available to the average taxpayer. These include the earned income credit, the child tax credit, additional child tax credit, and education credits such as the American Opportunity and Lifetime Learning credits. These credits help families raise and educate their children. The earned income credit is a refundable credit based on income and family size. Although mostly designed to help families, this credit is available to single persons and married couples with no children. There is an age requirement. Taxpayers must be between the ages of 25 and 65 to be eligible for the earned income credit. In all cases, the earned income credit is determined based on a sliding scale based on the relationship between your adjusted gross income and your earned income. Earned income is defined as money received from a job or net income from self-employment. So in the case of a job, it would be your W-2 wages, or in the case of self-employment, it would be the 1099 NEC and your Schedule C profit. If it's a loss, then it's not going to be helpful. A major development in mid-2021 involved the child tax credit, which is reported on Form 8812. This credit has always been a refundable credit, but until mid-2021, it had to be obtained by filing your tax return at tax time. Beginning in July 2021 and ending December 31st, 2021, up to 1/2 of the child tax credit was sent to families in advance based on information from either one's 2019 or 2020 tax return. For children under 5 years old, a family could receive $300 per month for the 6 months the program was in effect. For families with children ages 6 to 17, an amount of $250 could be received per month. The amounts received in advance in 2021 will reduce the amount of the credit received on the 2021 tax return. The IRS has been sending out letters to taxpayers. It's a letter, but it's called Form 6419. Will tell you exactly how much advance credit you received in 2021. If a Form 6419 is not received, one can confirm the amount on the IRS website and look at the Child Tax Credit Portal, irs.gov/ADVCTC. The advanced child tax credit discussed tonight is one of the many credits that are available that can help taxpayers reduce their tax liability. Information on these credits can be found at www.irs.gov. Thank you for your attendance. Our next topic in the series will be an in-depth look at some of the other credits available to taxpayers, including the Earned Income Tax Credit.
Thank you so much, Kathy.
You're welcome, Cecilia. Thank you.
Very useful information. And sounds to me that this year, more than a few taxpayers will not be very happy with the return as other years, right? Especially because of the confusion of the advanced child credit. That people thought that it was more money, but it ends up being the same money you're going to get when you got your return, but also unemployment.
Yeah, it's really true because I've been doing quite
Sounds
a
like
few returns.
people may have to pay or may not get as much.
That's exactly what's happening so far as like among my clients. I had, one particular client had quite a bit of unemployment and had very little tax taken out, but she has, a young child and she normally would have gotten a refund. But because she got the money in advance, she's winding up that now she has to pay. And she was really not very happy at all. I mean, she kind of had the idea that she wasn't going to get as much money as she usually does, but she was really
Maybe not the
very
extent.
disappointed that she had to pay. So, but it's just, it's kind of like, it's still the same money. It's just that people have already received it. So, but
yeah, it's a good
it
thing
doesn't make me feel too happy to tell people they
right.
have to pay.
You still don't have the money that you're used to getting this time of
Yeah.
year or a little later.
Right. So it's very, very disappointing so far.
Do you have any advice for people in terms of like what to do this year to avoid that disappointment for the return?
Well, I think, again, it's like each year lately has been completely different. I mean, most of the time taxes are pretty similar, except now in 2017, obviously, when this new tax law came into effect, there were a lot of changes, but it was just across the board. It was just everything. And then, so 2017, 2018, 2019 went along pretty similarly, like whatever people had, unless their particular situation changed dramatically, whatever they got in those years, they pretty much got the something similar the next year. But then 2020 returns, we had all the situations with the pandemic. And now this year that's continuing. So I think in 2022, hopefully taxes will go back to normal, because I don't think they're going to, at the rate they're going, I don't think they're going to reinstitute the advanced child tax credit. It seems like that's done. Less people are getting unemployment, thank God. So I think that maybe next tax season, everything will smooth itself out. But it's just been like a couple of years where a lot of totally unprecedented events have messed up people's tax returns. Like last year, everybody did great because it was, stimuluses and things like that. But now this year, it's not so good.
That's so great.
Yeah.
And then in case we have some homeowners that would like to know whether or not they should be hopeful for the salt. Do you see it going in that direction? Do you know?
I don't really see it
what a
going in that
difference.
direction, because they were discussing it just recently. They were discussing it, I think, last month. There was like, 2 weeks or so where, our representatives were saying, oh, we're going to bring this up. It's going to be repealed, and nothing happened. And I think
so if
I
nothing
think we're going to be
happens,
stuck with that for a while.
So if nothing happens, that means that people will still not be able to use the total of their mortgage, right? Like that, it will still be 10,000 only.
Well, not their
That is
mortgage,
like
just their real estate taxes
the
and their
real
state
estate
and local
taxes. I'm
tax.
sorry.
Right.
Yeah,
Yeah,
I knew
that's
that. I was
okay.
like,
Yeah, yeah,
the real.
the mortgage is always deductible. That's like, that's why, what, you know, as I said in the webinar, like really the only people that can itemize nowadays are homeowners because they have that, you know, relatively large deduction. So, I mean, it's great to have that on your taxes, but then when you have to pay it every month, that's not so great either. But
Right. You're
it's just
spending
like,
it.
yeah, but it's just like the cap on the real estate taxes really cuts into your ability to itemize.
Absolutely, yes. Yeah, especially as you said, for people who live in, Nassau County, Suffolk, and parts of the city. And then if you happen not to have included your 1098 when you did your taxes, can you change that at some point, or how do you amend it?
Well, it's always possible to amend a return. And as far as like tax preparation, an amended return is like one of the most hated things by accountants and tax preparers. But, you know, it's absolutely a thing that can be done, you know, even like with a 1098 or even it happens more often with income, not so much deductions, but especially with people that want to file very early. You know, they come in and they think they have all their papers and they don't. And then the only way to change it is to amend the return. But also the thing is too, like what you're saying about the 1098, if, you know, if you haven't received it, or if you feel there were, you know, maybe other things from your closing statement, if you just bought the house that you would need to include and you didn't, and the return was already filed, definitely you can amend. It's a form 1040X. And, you know, it's available to anyone for 3 years, you can amend the return. So like right now, if someone made a mistake or forgot to include something, either an income or a deduction on their 2018 return, this year is the last year for 2018.
Okay, so people
So
do still have some time.
Right. So after this year, you can't fix 2018.
We're very thankful, Kathy, for the information you shared. Sorry. To support our free services, you can go to www.cwny.org/membership. And there's also the donation, but our homepage will have everything there. So our locations, our phone number. Feel free to call us anytime. If you have suggestions about topics, feel free to put them in the chat or call us and let us know what you'd be interested in hearing about. That we thank everyone for joining us tonight, and we hope that you join us next month. And again, on the one-on-one tax preparation. Thank you, everyone. Have a great night.